Financial accounting operates as a highly sensitive, interconnected network where a single data anomaly propagates violently through the entire system. Within this network, inventory serves as the critical mathematical hinge. It is the specific asset that connects a company's balance sheet to its income statement. Because these core financial statements are mathematically interlocked, a physical misstatement at period end cannot remain isolated. It forces a reaction across the entity's profitability and equity metrics. We are going to track the anatomy of a single year-end inventory error, mapping its exact distortion across 2 fiscal periods to see how the system eventually self-corrects. Mapping this cascade helps build a structural intuition for how double-entry logic reacts to stress, moving beyond the application of memorized rules. To understand the error, we first establish the baseline formula. Beginning inventory plus net purchases equals the total pool of goods available for sale. Net purchases represents new inventory acquisition costs, minus discounts, plus freight in. At year-end, this total pool must be split into exactly 2 buckets. The first contains goods sold to customers, recorded as cost of goods sold on the income statement. The second contains unsold goods, recorded as ending inventory, an asset on the balance sheet. Because the top pool is a fixed sum, the allocation between these 2 buckets is a zero-sum game. The accuracy of the financial statements relies entirely on the precision of the final physical count. Counting what remains is more than just walking the warehouse floor. It requires verifying legal boundaries. Under FOB shipping point terms, legal title and risk transfer the moment goods leave the seller's stock. The buyer must record these goods as inventory, even while they are in transit. Conversely, under FOB destination, title transfers only upon arrival. The seller maintains the asset on their books throughout the transit period. In consignment arrangements, goods are physically held by a sales agent, but legally remain in the consignor's inventory until a sale is made to a third party. Failing to reconcile these legal boundaries with the physical goods on hand is the primary cause of systemic period-end inventory errors. Consider a scenario where a miscount occurs, perhaps a failure to exclude goods held out consignment, which artificially inflates the year-1 ending inventory. This source document shows year-1 effects. By artificially expanding the ending inventory, the math forces the recognized cost of goods sold down. Overstating the portion remaining mathematically mandates an understatement of the portion sold. This suppression of expenses alters the ledger. Artificially low cost of goods sold results in an inflated gross profit. Flowing to the bottom line, this creates an overstated net income. There is a parallel distortion on the balance sheet. The inflated ending count directly overstates current assets. As the statements connect, the artificially high net income flows into equity, resulting in overstated retained earnings. A single overcount at the loading dock distorts the company's profitability and asset valuation for the entirety of year 1. Accounting periods are linked by a precise transfer. The closing ending balance of year 1 instantly becomes the opening beginning balance of year 2. In year 2, the error moves to the top of the formula. The overstated beginning inventory falsely inflates the total goods available for sale. Assume the company performs an accurate physical count at the end of year 2. Subtracting an accurate ending pool from an artificially large starting pool forces an overstatement of cost of goods sold. This higher expense burden cascades down the statement, suppressing gross profit and ultimately resulting in an understated net income. The same physical error that inflated the company's position in year 1 forces it into a weakened position in year 2. Let's analyze the cumulative effect of this cycle on retained earnings over the full 24-month period. Year 1 added an inflated profit margin to the company's equity. Year 2 added a depressed margin to that same equity pool. These figures now offset. The overstatement of year 1 is canceled out by the understatement of year 2, resulting in a net effect of 0. While performance metrics for the individual years were distorted, the multi-year equity balance corrects itself. We can apply this logic to an inverse scenario. In this question, the true inventory figure is higher than the recorded amount, meaning the ending inventory is understated. Applying the zero-sum logic, if the bucket of ending inventory is artificially shrunk, the cost of goods sold must swell to absorb the difference. An overstated cost of goods sold represents inflated expenses, which understates final profit. This confirms option B as the logical consequence. By following the mathematical flow, the correct outcome can be deduced without relying on memorized charts. The balance sheet and income statement function as a continuous, closed-loop network. Every physical valuation error